Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about UTZ Brands INC quarterly report. UTZ Brands Inc. offers a diverse range of snack foods through various brands. Their products include salty snacks, potato chips, tortilla chips, pretzels, cheese snacks, specialty snacks, pub/party mixes, pork skins, ready-to-eat popcorn, seasonal favorites and dips, salsa and other seasonings brands, plus UTZ plus Zaps plus On the Border plus Golden Flake plus Boulder Canyon plus TORTIYHS, plus Hawaiian plus Bachman plus Tim's Cascade plus Dirty Potato Chips plus TGI Fridays plus Vintners. These products are distributed through various channels, including retailers, supermarkets, mass merchandisers, club warehouses, convenience stores, distributors, wholesalers, brokers, merchants, direct methods, DSD, direct store delivery, and direct-to-warehouse distribution. The significant drop in UTZ Brands Inc. stock price can be attributed to several key factors. The company's third-quarter earnings report revealed plummeting operating margins, with a decline from 5.3% to 0.9%, indicating rising costs eroding profits. Additionally, the net loss attributable to controlling interest increased significantly, and gross profit margin decreased by 2.3 percentage points year-over-year. Furthermore, UTZ lowered its full-year sales growth projection in September 2024, citing a more competitive promotional environment and value-conscious consumers. The company also missed analyst expectations for EPS in Q2 2025, contributing to the decline in stock price. Analyst downgrades and price target cuts further exacerbated the situation, with UBS Group repeatedly lowering its price target and Weiss Ratings reissuing a sell rating. These factors collectively contributed to UTZ Brands' stock price dropping by over 38% in the past year, hitting a new 52-week low of $11.50. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the expansion into new markets, including expansion geographies and the California market through acquisition and existing operations. Additionally, investments in marketing and innovation have contributed to revenue growth. The acquisition of Insignia International's DSD distribution assets has also been a significant driver. On the other hand, revenue decline can be attributed to lower net price realization and a decrease in non-branded and non-salty snacks net sales. Net sales decline of -5.3%, 13 weeks, and -0.4%, 39 weeks, have also contributed to revenue decline. The mixed or neutral impact category includes factors such as increased sales of notes receivable, revenue growth due to favorable volume/mix, but gross profit declined by -0.8%. Net income decreased by $10.4 million due to various factors including increased interest rates on unhedged debt, tax provisions, commodity cost increases, and rising labor and transportation costs. As a result, profit margins declined from 35.8% to 33.6%. The decrease in profit margins was also attributed to increased competition and promotional activities in the U.S. retail sales for salty snacks. The company's financial performance indicates a positive trend in its operating cash flow. According to the financial summary, the company generated $47.3 million in net cash provided by operating activities for the 39 weeks ended September 28, 2025. This is a clear indication that the company is successfully managing its operations and generating sufficient cash to support its business needs. The company's debt level has increased significantly over the past year. Total liabilities rose from $1,340.7 million to $1,414.5 million, indicating a substantial increase of $73.8 million. However, there is some variation in the data, with another source showing an increase from $768.6 million to $850.7 million. On the other hand, interest expenses have decreased over the same period. The company's interest expense for the 13 weeks ended September 28, 2025 was -$10.6 million, a decrease of $2 million compared to the previous year. Similarly, the 39 weeks ended September 28, 2025 saw an interest expense of $33.5 million, a decrease of $3.1 million from the same period in 2024. Overall, while debt levels have increased, interest expenses have decreased, indicating that the company is managing its debt effectively and reducing its financial burden. Management is optimistic about the company's outlook, citing a long-term growth strategy that focuses on accelerating investments in marketing and innovation. They expect consistent retail sales for salty snacks due to consumer trends and believe they can effectively compete with key factors such as taste and convenience. To drive growth, management plans to expand the branded salty snacks portfolio and penetrate new markets. However, they also acknowledge rising costs related to fuel, freight rates, and labor, which they intend to offset through manufacturing and distribution efficiencies, as well as price increases. Management is confident in their ability to generate sufficient liquidity for working capital needs, citing a combination of cash provided by operating activities, revolving credit facility, term loans, and derivative financial instruments. Overall, the company's strategy appears to be focused on driving growth through investments in marketing, innovation, and geographic expansion, while managing rising costs and maintaining liquidity. Acquisitions and divestitures overview. The company has made significant investments in acquisitions and divestitures over the past few years. Key acquisitions include the investment in UBH, Kennedy Endeavors, regional brands and distribution capabilities, branded salty snacks portfolio expansion, and Insignia International's DSD distribution assets. On the other hand, the company has also undergone several divestitures, including the planned closure of a manufacturing facility in Grand Rapids, Michigan. The sale of certain assets and brands to affiliates of Our Home was completed in 2024, which included the Good Health brand, RW. Garcia brand, 2 manufacturing facilities, and related assets. Additionally, the company sold its Las Vegas, NV facility lease and manufacturing operations for $167.5 million, as well as its Berlin, PA, and Fitchburg, MA manufacturing facilities and certain related assets. The company has also transitioned to managing distribution routes through independent operators, with substantially all DSD routes now managed by IOs as of September 28, 2025. The total value of these divestitures is significant, with the Good Health and RW Garcia sale alone totaling $44 million. These acquisitions and divestitures demonstrate the company's strategic efforts to optimize its operations and focus on key business areas. The company has a history of paying out dividends to its shareholders. In the past 2 years, it has distributed significant amounts, with $16.9 million paid out in 2025 and $15.9 million in 2024. Additionally, there are accrued dividends and distributions totaling $8.7 million, indicating that the company continues to prioritize dividend payments. Concerns about inventory buildup and supply chain disruption. The company is facing concerns about inventory buildup and potential supply chain disruption. Financial data reveals a significant increase in inventories, with an $11.5 million rise on page 1 and an additional $6.7 million increase on page 36. This buildup may be attributed to the consolidation of manufacturing footprint, page 26, and the acquisition of Insignia International's DSD distribution assets, page 28. Furthermore, rising costs related to fuel and freight rates, page 29, may impact transportation costs, and commodity cost increases could adversely affect net income. These factors collectively indicate a potential for supply chain disruption. The company's reliance on complex supply chains, as evidenced by the Supply Chain Finance Program, page 15, adds to these concerns. Addressing these issues will be crucial in maintaining efficient operations and mitigating risks associated with inventory buildup and supply chain disruptions. That concludes the financial summary for UTZ Brands INC. Feel free to comment below, and I will be happy to answer them when possible.